let's just jump right in. We've been digging through a pretty significant stack of research lately.
Mm-hmm.
And these sources, they're not focused on the big, exciting headlines, the AI boom or the stock market hitting new highs.
Right. They're looking underneath all that.
Exactly. They're looking at the fundamentals. And what they suggest is, honestly, a chilling possibility.
That we might be heading for something bigger than 2008.
That's the phrase they use. That 2008 might end up looking like, and I'm quoting here, a dress rehearsal.
And it's such a paradox, isn't it? Because on the surface, the mood is celebratory, asset prices are sky high, earnings look okay.
Yeah, everything seems fine.
But the deep data points, the structural stuff we've pulled, are just screaming a warning. It feels like it's being widely ignored.
So that's our mission for this deep dive. We want to cut through the noise, cut through the optimism, and just extract the hard numbers.
The specific data?
The yield curve data, the valuation ratios, the debt figures, all the things our sources say show the economy is running on borrowed time and borrowed money.
Let's do it.
So let's start with what our sources call the longest warning in financial history, the yield curve.
Right.
Now, for anyone not tracking this daily, a quick recap. The yield curve just compares interest rates on government bonds. Normally, long-term bonds pay more. Simple.
Exactly. But an inversion is when that flips, when short-term rates are suddenly higher than long-term rates. It's unnatural.
And it basically signals that investors see a big slowdown coming.
A huge one. And its track record is, well, it's pretty much undeniable. Since 1960, every single U.S. recession was preceded by an inversion.
Every single one.
The accuracy rate is 94%. It's the most reliable predictor we have.
So with that in mind, what was so startling in the source material about the most recent inversion?
The length, just the sheer length of it. We just lived through the longest yield curve inversion in recorded history.
How long are we talking?
It ran from October 2022 all the way to December 2024. That's over 2 full years.
Wow. Okay, put that in perspective for us.
Well, think about 2008. The inversion that came before that massive crisis. It lasted about 7 months.
7 months.
And the dot-com bust in 2001, that inversion was about 9 months. So this one was more than twice as long as anything we have ever seen.
But hold on, because that's the counter-argument, right? If the warning was flashing for 2 whole years, why didn't the crisis happen in 2023 or 2024?
Yeah, that's a fair question. And the sources point to 2 main things. Massive, and I mean massive fiscal stimulus, and a surprisingly resilient labor market.
So the government was essentially just pumping money into the system.
Trillions of dollars. It kept people spending, even while the bond market was screaming, slow down. It created this unprecedented divergence. The pressure was building, but the government kept overriding the signal.
And that leads to the psychological trap. The curve finally normalized in December 2024. People breathed a sigh of relief.
A huge sigh of relief, but that is completely misplaced.
Because
historically, the recession doesn't start during the inversion.
it starts after.
It typically begins after it ends, usually about 6 months after. So the warning isn't over. The fact that it normalized means the slowdown is likely imminent. We are now smack in the middle of that historical danger window.
So the longest warning sign ever is suggesting immense stress. Which brings us to the next question. What is this system trying to support? What's the debt load look like?
The numbers here they're just mind-boggling. Global debt hit a new record high, nearly $323 trillion.
$323 trillion.
And if you look at that as a percentage of global GDP, it's 331%.
So for every $1 of economic activity,
There's more than $3 of debt behind it. The system has almost no cushion, no margin for error.
is that mostly governments or corporations driving this?
It's across the board, really, but the fragility in the U.S. is very much driven by corporate debt. It's climbed to $12.1 trillion.
And what's troubling, according to the sources, is what they're doing with that money.
Exactly. It's not going into building new factories or R&D or anything productive.
It's financial engineering.
100%. It's being funneled into stock buybacks, big shareholder payouts, refinancings, things that artificially pump up the stock price without actually growing the business. They're borrowing to create the illusion of health.
Which is the perfect segue to valuations. The elephant in the room, as one source put it.
And the best way to look at that is the Buffett indicator.
Right, Warren Buffett's favorite metric. He basically compares the total value of the stock market to the size of the economy, to GDP.
Yes, and his warning line, the point where he says you're playing with fire, is 200%.
And where are we now, as of September 2025?
We are at a shocking 230%.
230.
It is the highest level in recorded history,
Hmm.
higher than the dot-com bubble, higher than the lead up to the 2008 crisis. By any sensible historical measure, stocks are more overvalued today than at any other peak.
But the argument against that, the bull case, is that the economy is different now. It's more tech-focused, asset-light. The old rules don't apply.
And the sources tackle that head on. They say, okay, fine, let's look at other metrics, like the price to sales ratio for the S&P 500. It's at 3.33, another all-time high. The previous record was 2.27, back at the absolute peak of the dot-com mania. So it doesn't matter if you measure against GDP or actual revenues, the disconnect is still extreme.
It really highlights the psychology. There was a Bank of America survey where 9 out of 10 fund managers said stocks are overvalued
Yet they keep buying.
because of that fear of missing out. It's the classic narrative. This time it's different. We have AI.
And it's the exact same thing we heard in the late 90s with the internet, or in the mid-2000s when they said housing prices could never fall. The technology changes, but the human psychology, that rationalization, is identical.
Okay, so we have record debt, record valuations. Now let's get into the specific things that could actually puncture the bubble, starting with commercial real estate.
The CRE time bomb. This is a huge one. We're talking about office towers, retail centers.
Not houses.
No, not houses. And that whole sector is facing a tsunami of loans that are about to mature.
A tsunami to the tune of $1.8 trillion in 2026 alone.
And you have two problems hitting at once. One, all those loans were written when interest rates were basically zero. Two, the market fundamentals are terrible.
Remote work.
Remote work has crushed them. Office vacancy rates in big cities are over 20%. That's the highest ever. The buildings just aren't making enough money.
So what happens when a loan written at 3% has to be refinanced at today's rates?
While the payments can go up by 75, even 100%, the owners can't make those payments, especially if the building is half empty, so they hand the keys back to the bank.
And those losses fall directly onto the banking system.
Right onto the banks. Which brings us to the next point, banking fragility.
Our sources point out U.S. banks are already sitting on $482 billion in unrealized losses.
And that word, unrealized, is so important. We all remember Silicon Valley Bank in March 2023.
Of course.
Their problem was simple. They were forced to sell their low-interest bonds to pay back depositors, and that's when the unrealized loss became a very, very real, solvency-threatening problem.
And the source material says if the 10-year Treasury yield gets near 5%, and it's hovering around 4.5 right now, those unrealized losses could hit $600 or $700 billion.
That's the danger zone. You combine that with a wave of CRE defaults, and you could see multiple regional banks get into serious trouble at the same time.
A systemic version of SVB.
A systemic version of SVB. And that's when credit markets just freeze.
Meanwhile, we're seeing this weakness finally start to bleed into the labor market, which has been the one strong pillar.
Right. The official unemployment rate is now 4.4%, highest since late 2021.
4.4 doesn't sound catastrophic on its own.
It doesn't, but you have to look at the trends beneath it. Hiring rates have dropped back to where they were in early 2011. Businesses are pulling back.
And what about that canary in the coal mine you mentioned?
That's where you see the real stress. For Black women, for example, the unemployment rate has jumped to 7.5%, and the average time someone is unemployed has spiked to 18.5 weeks.
So the foundation is getting weaker.
The foundations are clearly deteriorating. It's signaling that a big slowdown in consumer spending is coming. That's a $430 billion tax hike, essentially. It's just going to get passed on to consumers and keep inflation high, so you get the worst of both worlds.
Slowing growth and persistent inflation.
The textbook definition of stagflation. The 1970s nightmare.
So the Fed is completely trapped.
Absolutely. They can't cut rates aggressively to help the economy because inflation is too high. But they can't keep rates high because the whole debt structure starts to break. They've run out of good options.
So let's map out that nightmare scenario. How does the house of cards fall, according to the sources?
It starts with those stress points. Defaults begin in commercial real estate. That puts major losses on regional bank balance sheets.
Which triggers depositor panic.
Exactly. Then credit markets seize up. Companies that need to roll over their debt, and remember, a huge chunk of corporate debt is maturing in the next 3 years, they suddenly can't get financing.
And then corporate defaults begin to spike.
And that's when it hits the real economy. Unemployment shoots up, consumer spending, which is 70% of our economy, collapses. And the stock market, starting from its all-time high valuation, has a major correction. A 50% drop wouldn't be out of the question.
So the big question, why could this be worse than 1929 or 2008? The sources point to three main factors.
Factor one is just the sheer scale of the debt. In 1929, total U.S. debt was about 190% of GDP.
Oh.
By 2008, it was up to 350%. Today, total U.S. debt is over 400% of GDP.
So we have way less capacity to absorb a shock.
Way less. Factor two is the exhaustion of policy tools. The Fed is out of ammo.
What do you mean?
In 2008, the Fed cut rates from 5.25% all the way down to zero. They had a lot of room to maneuver.
And today?
Today, we only managed to get rates up to 4% before things started to break. So if a major crisis hits now, they have less than half the firepower they had in 2008.
And the third factor is that all these problems are happening at once.
Precisely. 1929 was a stock market bubble. 2008 was a housing and banking crisis. What we have now is a combination of everything. Overvalued stocks, CRE stress, fragile banks, a corporate debt overhang, and persistent inflation. They're all interconnected.
Okay, so for you listening, what are the immediate warning signs to watch for? The sources give 4 specific trigger points. The first is the 10-year Treasury yield breaking above 5%.
That would immediately worsen the bank's unrealized losses and make CRE refinancing basically impossible. The second is a sharp widening of corporate credit spreads.
Which means investors are suddenly demanding much higher interest to loan to companies because they're worried about defaults.
Exactly. The third trigger would be obvious systemic stress, an SVB-style bank run that affects multiple banks at once.
And the fourth is external, a sharper than expected slowdown in China.
A crisis there would send massive ripple effects around the globe.
At the policy level, the message is clear. Regulators need to run serious stress tests, and the government has to get its unsustainable debt under control.
But for you, the individual, what can you do? This isn't about panic. It's about clear-eyed risk management.
Stress test your own finances.
Exactly. Ask yourself, what happens if I lose my job? What happens if my portfolio drops by 50%?
And the advice is to build up your emergency reserves now, reduce high-interest debt now while things are still relatively stable.
It's all about fighting that one human tendency, normalcy bias.
The belief that because things feel fine today, they'll be fine tomorrow.
We see it before every crisis. Irving Fisher in 1929 declaring a permanently high plateau just days before the crash. The key is to see the risk and act on it while you still have time.
So to wrap up, we've seen the hard data. The longest yield curve inversion in history just ended. Valuations are at the highest point ever recorded. Global debt is at 331% of GDP, and the Fed is trapped.
The warnings are all there, and the longer they go unheeded, usually the more severe the correction is when it finally comes.
JP Morgan's research right now puts the probability of a U.S. recession by the end of 2025 at 40%. So given everything our sources suggest, that we have less capacity to fight a downturn than in 2008, the question for you isn't really will it happen, but what specific personal resilience plan do you put in place when the odds of a major systemic event are running that high? Something to think about.